Good morning, everyone. Thank you for attending today's webinar that's being hosted by Ferrazzano, a law firm in Chicago, RSM, a accounting and consulting firm that has a national practice, as well as Piper Sandler, a financial advisor and investment banking firm. Very excited about today's seminar. Thanks again for coming. Believe it or not, we've done this now for probably over a decade, reaching back to the last the crisis back at the end of the first decade in 2000. Of course, then we were on the telephone, so that was before Zoom and Teams and Blue Jeans and all the video platforms that we're struggling with every day for the past year to communicate. But it's our pleasure to be here and to share with you some of the insights that we have gotten over the past year, and the questions that we're getting from clients and things that we've seen out in the industry. So my name is Rob Fleetwood. I'm the co-chair of Ferrazzano's Financial Institutions Practice. I will be, for lack of a better word, hosting today's webinar along with John Behringer with RSM. We are very excited to be with you guys today. We've got a great group of attendees. I was looking over the list this morning before dialing in. We've got a great number of people attending today. We've got people from large publicly traded banks to smaller community banks. So we've got a wide range of institutions, as well as a wide range of people in terms of, we've got directors, officers, operations folks, investors, the like. So appreciate everyone dialing in and attending. We also have a great group of panelists, and you can see the folks up on the screen who are going to speak today. What we try to do on these is to provide some practical viewpoints of things that we've seen and things that we expect in the industry over the next few months. We, between our firms, touch thousands of financial institutions and deal with banks on a day-to-day basis. So we certainly are in the trenches and are eager to share that insight with you. Particularly now, we're a year into this pandemic. I know everyone's aware that we've heard the first anniversary of the shutdowns and the big effect on NASDAQ and the stock markets earlier last week. But things are starting to open up. I'm in Chicago. I come into the office a few times each week. Every time I come in, it's a little more busy in downtown. Today, went to the coffee shop in the lobby of our building and actually had to wait for a cup of coffee. It was crazy. There were probably 15 people in the coffee shop waiting, and a colleague of mine was there, and we were chatting that we hadn't been around that many people in quite a while. So signs are that things are starting to open up. So there might be some unique things that banks will be facing and dealing with over the next few months as a result of that. So today we're going to have Brandon talking about the current economic environment and some tidbits of what's going on in DC. We'll then kick it over to John and Abdul, who will give us the status of the M&A markets and the capital markets. Fritzy will be talking about some contract issues that we've been seeing with our clients over the past few months, particularly data processing and contracts related to fintech services, which I know banks are dealing with on a day-to-day basis right now. Jennifer and Anthony will talk about ESG, and then we will conclude before Q&A with the Behringer report, which it's great that they're able to make what's going on in the regulatory world interesting and entertaining. So I'll kick it over to John now from RSM. John?
Thanks, Rob. And again, RSM is excited at our continuing partnership with Barrick and Piper as we bring these, it feels like almost on a quarterly basis. So since the last time we were all together, obviously the election and change in administration took place. So the goal in putting together today's panel agenda in part was to touch on some of those issues, as well as we've obviously got the pending Libor transition. So John Geiringer and I will touch on that, as well as really the change in administrations and focus on consumer compliance and issues, both at the federal and state level. So with that, just from a housekeeping standpoint, on the bottom of your screen, you should see a chat box as well as a Q&A box. Feel free, as we're going through the rapid fire presentations here today, to enter any questions you may have in the Q&A box. And with that, we'll be monitoring it and look to respond to those as quickly as we can during today's discussion. With that, then I'm going to hand it over to Brandon to go ahead and get us started talking through an economic update.
Thank you, John, and good morning, everyone. Here we are 1 year removed from quite an experience last March when everything shut down rather rapidly and the unknowns began to mount. And despite what we had experienced back then, we are in a very unique position now, and we'll talk a little bit about that in terms of what the growth prospects look like in the country. But over the last year, and I don't want to spend a lot of time diving into it, but we had a lot of records. We saw record contraction in GDP. We saw record unemployment. We saw records broken in jobless claims that all mounted and added to what was really this period of uncertainty because of a global health pandemic that impacted the country in a way that I don't think many of us thought was possible. But a lot has happened in that past year, and here we are a little over 365 days later, and the prospects for economic growth look to be rather positive. As you can see here on the slide, RSM's current modeling is showing strong recovery, strong growth here in 2021, and well on into 2022 and 2023. Given a lot of what has happened in terms of fiscal and monetary measures that have taken place, the outlook specifically as we look into Q2 and Q3 looks to be rather robust. And we're talking a lot with our clients, whether it be on the banking side or on the operating side, like industrials, consumer products, and the like, to kind of start looking ahead and what that recovery may mean for you. And when you break it down into its components, the recovery is really kind of a combination of things. We saw the Fed move into action rather quickly last March with their lowering of rates, followed by the CARES Act implementation and passage in late March, which I think everyone on the phone is very familiar with, the Paycheck Protection Program and what that did for your borrowers, your communities, and others that you interact with. But when you take everything that has happened from just a fiscal standpoint alone, we've seen roughly $5.5 trillion worth of aid and stimulus that has been put into the economy. When you add that to the elevated savings that a lot of consumers have had, and if you take a look back historically what the savings rate in this country have looked like, we've seen close or to around 10% savings rate. That elevated in Q2 of 2020 to roughly 30% and still remains elevated somewhere in the mid-teens to this day. So when you have the aid that's been put into the economy, plus this cash sitting on consumers in consumers' checking accounts sitting on the sideline, the anticipation that consumers are going to have this pent-up demand that they want to then roll into the economy to begin spending and doing those things that they did over a year ago, the baseball games, sporting events, the concerts, theater, eating out, and the like. As we see more vaccinations put into arms, as we see the economy reopen, as Rob said when he was getting coffee, all of those are amounting to really kind of this deluge of activity in the economy that's gonna be creating a really prosperous time for the near future here. We've seen a lot of positives. Unemployment continues to fall. We saw a really good print on jobless claims, the initial jobless claims and continuing jobless claims this morning. In fact, the initial jobless claims are the lowest they've been in over a year, with I think 684,000. So this is all positive news. And we think a lot of this will continue on throughout the rest of 2021 and beyond. But there still is just a few things to be mindful of in terms of what could impact the outlook. Obviously, any surge in the cases brought about, namely because of the variants that we're beginning to see in the country, could create some compression in the growth. And what we're really looking out for is anything in terms of what could happen from a policy standpoint. And we'd look at it more of a policy error. Could things change either in a fiscal or a monetary standpoint that might cause questions to amount with what the recovery could look like? The interest rate outlook, I think everyone's aware that, from just a pure treasury standpoint, those are beginning to move in an upwardly manner. At RSM, we've been doing modeling around the 10-year, and currently our model shows that by the end of 2021, the 10-year would be sitting right around 1.75. Right now, as of this morning, the 10-year is sitting at 1.59, so not far off of 1.75. So likely that we'll see that continue to move up. I think the theme here, though, is that the floor that we saw, or the bottom that we saw with rates in late 2020, are moving in an opposite direction. Maybe not as fast on some rates as some would like, but the compression that we saw, and we'll show in a later chart here, in terms of net interest margin, is beginning to ease and subside. We still expect the front end of the curve is going to be anchored at zero by the Fed. Whether you were monitoring or paying attention to Chair Powell's press conference last week, or you've seen any of the testimony this week on the Hill, or any of the other Fed speak that's come out, a lot of conversation centered around patience, and that they're willing to wait as long as it is to ensure that we see full economic recovery, which means not only price stability, but also seeing that maximum employment. The last thing I'll just say here from the outlook standpoint is, as we see the economy improve, as we see recovery begin to spill into areas of the country that were more severely impacted, hospitality, leisure, the services sector, we anticipate these financial conditions are going to continue to improve. Lending, we anticipate to come back. I would suspect that there are some on this call that would say it should come back sooner rather than later. But as that happens, we're going to begin to see that growth on the balance sheet, not brought about by stimulus lending, but actual real lending to a company looking to grow and expand. So let's move to the next slide here. This is one of my favorite slides that just shows us a snapshot of where we're at from just an economic capacity standpoint. And you can see here, this index is something that's comprised by Moody's, and you can Google it, back to normal index. I'd encourage you to do it after this webcast. But it gives you a snapshot on where the country is, as well as where states are at in terms of returning to quote unquote normal. And this 86% reading here, based off of the modeling that Moody's has created, is actually the highest reading that I've seen on this since mid-August of 2020 when they released this. And one important thing that I'd point out, there's the number of states with improved scores since last week is at 49. That's the largest that number has also been since this index was released back in August of 2020. For anyone that's really interested in the modeling and the data behind this, if you do go look at this, Moody's has made available the various metrics that fall into this. But I like to show it because if you think of your bank and where you reside, or the branches that you have in the various geographies around the country, it gives you an idea of what's happening in a particular location. And thinking of the restrictions and all of these rollback, or at least now rolling back the restrictions in the economy, we anticipate to see this continue to improve. If you look just back 2 months to where we were coming out of the holidays, this was actually in the upper 70s. And to move from 78% to 86% is actually a very meaningful change. One other thing I'd point out, if you just are interested in more data around what's happening in the economy, Moody's has also published through CNN a lot of additional information. So if you do go look at this, you're going to be able to see a lot of information from either an economic standpoint or real-time high-frequency data that will help you understand what's happening in various pockets of the economy. So one thing that when you see an economy running at kind of below optimal is, what does that look like from a growth standpoint? And here on the next slide, we've tried to visualize that for everyone. And what we're showing here in the green line is essentially the real potential GDP, or what GDP could look like on a normalized growth pattern. And then this gray line is the actual real GDP. And you can see where we're currently at based off of what happened in 2020. We had a substantial contraction in growth in the country. Now we've seen that rebound in Q3 2020. It rebounded further in Q4 2020 and likely to continue to move up. But there's an output gap that's been created. And really what monetary and fiscal policy leaders tried to do is they tried to find a way to help fill that gap. Because if you look back to the last recessionary period that we had, it took a considerable amount of time for the country to really get back to an optimal growth pattern. And what we're seeing and hoping, and the hope from a lot of the fiscal sources, and especially if you listen to Chair Powell as he speaks, is seeing this recovery come back quicker so that the economy can get back to firing on all cylinders, and we can get to that growth that they would anticipate over a longer term horizon. We'll update this chart, I believe, when we get into April, once we see the first quarter print of 2021. But the anticipation is this gap is going to continue to close. And hopefully by the end of the year, we see it at a much tighter reading than what we did coming out of the great financial crisis. You can't have a period of recovery without talking about interest rates. So in the next slide, we're just going to show you where the yield curve is at, both on a real and a nominal basis. Obviously, yields have been moving up. If you were to look at this particular yield curve 2 months ago or latter part of 2020, you would have saw both real and nominal yields negative, or as you would have saw, the inflation adjusted yields all in the negative territory. So to see those moving up on the longer end to 10 years and right around 7 years is actually quite impressive. We still have low rates on the short end of the curve. That's not surprising to anyone, but with the improvement in the economy, we expect that these will continue to move up. You know, the Fed is obviously spending a lot of time talking about interest rates and in that trajectory. I think at this point, the Fed's comfortable in letting the rates move in a free manner based off of where the markets are without shifting any of their current policy course. So more to come, more to be mindful of and aware of. But as interest rates become more of a topic of conversation, as does inflation. So we just want to spend a couple of moments talking about inflation because it seems to dominate a lot of the headlines. So we've got 2 slides here for you. This one here is really the kind of a real-time indicator, if you will, of where inflation is looking or at. And this is something the Fed pays attention to when they can't necessarily point to the real or the published monthly inflationary data. And you can see here we've charted for you the 20-year average for inflation as well as the Fed's policy mandate of trying to target that 2% inflation. We have seen a noticeable uptick in this reading. And I think if you look at the hard data that comes from the Fed or comes from various economic sources on a monthly basis, it's not going to come as a surprise. I think it's important, though, when we talk about inflation, just to have perspective. When you have the shocks that the economy experienced in 2020, to see an uptick in inflation really is not expected. And in some pockets or some segments of the economy, you're going to see more noticeable or more increase in prices just based off of the shock they experienced. So to see the uptick here from the middle part of 2020 into our current reading here of March 2021 isn't surprising. What's important is to understand when you look on a year ago basis, you're going to see that. The Fed has made it very clear that they're looking at this from a long-term standpoint based on just a static reading as of this moment in time. So their view on the long term is that they're going to see inflation increase above that 2% level here over the near term in 2021, but they believe once we continue on into the recovery, it comes back down into closer to that 2% reading. And another slide just to help visualize that. If you look at the Treasury break-evens for the 10-year and 5-year, that helps kind of inform or at least show that the inflation expectations on a longer-term basis do indeed subside. You know, a reading above 0 on this particular data visualization would show you that the short-term inflationary expectations or the longer-term inflationary expectations are substantially higher than the short-term. But in this case, we see the inverse, where the longer-term inflation expectation, just based off of these break-evens, is that, you know, we're anticipating longer-term inflation to be much more manageable. Now, you can't have an economic update specifically with bankers without talking a few things just from a banking standpoint. And we've got 2 charts we're just going to show you here. The first one is just net interest margin. Obviously, for the industry, 2020 saw some contraction and compression. Not a surprise to anyone on this webcast. But to see it now hopefully bottoming out and moving in an upward manner, I think is a positive. The next slide, real quick, just asset quality. You know, a year ago, everyone was asking what's going to happen to my loan portfolio? What do those losses look like? And I think just to kind of speak here with the group that we have, you know, not to say that there isn't still concern out there in the portfolios of banks, but there's a lot more clarity. And I think some of the things that happened from a regulatory standpoint early on have really allowed banks to be able to manage their portfolios well in order to keep losses down and to keep losses down as we move on into recovery. And then real quickly here, as we bring this to a close and move on to M&A, just want to talk on what's happening and what the outlook looks like in Washington. I don't think anything comes as a surprise here, but really there's still this focus on getting the virus under control and getting the vaccines out to people. We're seeing roughly 2.5 million shots put into arms on a daily basis. That number is continuing to climb. Highly likely that once we get into the summer, July, August, that we could see a very positive rate of vaccination that's going to help us get back into a more, what we like to think of as what that normal feels like. There's a lot of talk about infrastructure policy. Obviously, coming out of the $1.9 trillion aid package that we just saw pass at the beginning of the month, infrastructure is kind of one of those things that's going to have a lot of attention paid to it from both sides of the aisle, especially how it gets paid for. We anticipate there's still going to be a lot of talk around trade, kind of repairing, if you will, or at least rekindling trade relationships based off of what Biden's looking to do. We've seen climate change become a real hot topic of conversation. And I know one of the things we're going to talk about here shortly is ESG, and obviously climate change falls into that. And then the last item here is tax. If you roll back and just look at where we were in October, when there was this anticipation of a very large blue wave in DC, tax was a very big topic of conversation. I do think tax will come up, but I think as policymakers look at the recovery, tax kind of takes a back seat for the time being as they continue to focus on rebuilding America. With that, I'm going to pause, take a breath. Thank you all. And I am going to turn this over to John with Piper and Abdul with Behringer. Thank you.
Great. Well, hey, thank you, Brandon. Yeah, unique times indeed. Great update. And this is John Freechak with Piper Sandler in Chicago. And I'm going to give the investment banking perspective here on the M&A markets. Abdul Mitha from Behringer joining me, of course, to give the attorney's viewpoint. And a lot of what Brandon just touched on, as you would imagine, is really, driving M&A discussions today. And so if you've been with us for some of the previous webinars that John Behringer referred to earlier, a lot more focus at that point in time was paid to the capital markets. There were a few M&A transactions taking place in the bank space, but largely driven by deals that, if they weren't fully baked already pre-COVID, discussions had begun well before the pandemic began and just continued during those months. You didn't see a lot of new M&A taking place, and for good reason, where nearly all of our bank clients were focused internally and focusing on their customers. How do we manage this PPP loan program? How do we manage our employee base working remotely for the first time? And so what we're now seeing in particular over the last couple of months here at Q1 board meetings is the ability of bank management teams and boards to kind of come up for air, if you will, and for the first time in about a year, start to look externally again and say, okay, I'm starting to feel better. A lot of what Brandon just touched upon, I'm starting to feel like we've got a little bit more clarity on the outlook here. We're certainly not out of the woods yet, but credit, it's hard to believe, Brandon kind of, glossing over credit there. And that's what we're seeing from the bank investor universe as well. You never would have believed it last summer, but, the bank investor universe seems to believe that the industry has credit under control at this point. And now from an M&A context, of course, you still need to be careful with that, where if you're looking at acquiring another bank and they've got a hotel loan that's still running at a fraction of capacity, you're going to look pretty hard at that and make sure you get your arms around it. But it is an area where some of the more dire predictions we saw last summer, knock on wood, look like they are not going to come to pass. And so we're getting clarity on a number of these elements: the 2020 election, the latest round of fiscal stimulus, and of course, coronavirus, COVID-19 vaccinations and herd immunity. And so now, with all of that coming into focus, we're seeing banks look and say, now, what do we do in terms of actually being able to grow our organization from the standpoint of both earning assets, loan growth, as well as earnings? And it's an interesting conundrum where all of the elements that Brandon just touched upon, where we are in a challenging rate environment, patience that the Fed is going to show is going to need to be required, I think, by a lot of our bank clients who are sitting on good core deposit bases. And on a weekly and sometimes daily basis, I'll have a conversation with a client that says, John, we're sitting on a very strong core deposit base, and it feels like it's valueless right now. And there's an element of truth to that, where in this interest rate environment, it's it's difficult to differentiate yourself with a strong core deposit base when wholesale funding is at rock bottom pricing. And so there's going to be a need for patience for a lot of these institutions to wait to get back to the rate environment that Brandon described a moment ago, where that becomes more valuable again. Now, in terms of driving M&A, we talked about the challenging rate environment. I hope Brandon's right about the economic recovery, but in the meantime, organic loan growth is a real challenge. And we're hearing of competitors who are starting to give on not only yield, rate, but also on terms to try to drive organic loan growth by stealing market share from other banks in their marketplace. That can be frustrating. And so just trying to replace the PPP loan volume this year is going to be an uphill battle for a lot of banks. You combine that with the fact that we are sitting on a lot of excess capital in the industry right now, and that's another driver for these bank boards and management teams to look and say, well, what if we were to go out and acquire another bank? That could drive some earnings accretion. We take out some cost savings. That could help drive some loan growth as well. Maybe we get in some new markets, put on some new earning assets. And so you're seeing a lot of refocusing externally here in the first quarter. And those discussions are going to drive transaction announcements here in the second half of the year. And so you haven't seen it materialize yet, but the discussions are taking place. And if you're not already, you should at least be re-educating yourself as a management team, re-educating your board on what the environment looks like to make sure that you're ready as either a buyer, not necessarily a buyer or seller, but just re-educating yourself on how do we prepare ourselves to take advantage of that. And before I pass it to Abdul, the capital markets, which again had been the focus the last couple webinars we had, but to reiterate some of the themes from those discussions, the capital markets do remain wide open for banks on the debt side, preferred subordinated debt in particular. We are seeing community banks consistently issuing below 4% in the subordinated debt space. And so if you don't already have excess capital, that is very much an avenue that you can utilize to fund an acquisition if needed as well, or growth going forward. Abdul, would love to get your thoughts there on what you're seeing in the capital markets, and in particular, some of the pre-planning that you are seeing with your clients.
Thanks, John. This is Abdul from Ferrazzano, and just for me and everybody else on the panel again, and from Behringer, we thank everyone for joining us today, and and we look forward to seeing everyone again in person. We started doing these conferences in person and haven't been able to do that in a couple of years. So I know I'm feeling the lack of touch points with some of the people that we know, and hopefully very soon we'll be able to get back together. But John, you're absolutely right. The sub-debt market, it's still hot. It still has a lot of traction. At this point, from a documentation perspective, it kind of, these documents are pretty standard. All the investors kind of know what they look like. So there isn't a lot of back and forth. There isn't a lot of negotiation for the most part on these documents. So for planning purposes, if you're looking to do a sub-debt issuance, the items that require the most lead time are the deck, the investor presentation that in large part your placement agent or investment banker will craft, which provides the financial information and the selling points to convey the proper message for potential buyers. The other item that sometimes is at play is if it's desirable to get a ratings from somebody like Kroll or from Egan-Jones, that's a couple of 3 weeks lead time process. For some of the smaller sub-debt deals out there, we're really not seeing folks get an investment grade rating, but to the extent that any of the sub-debt is marketed to asset managers, for example, or insurance companies, especially for insurance companies, they look at, they have regulatory kind of expectations to risk weight their assets and portfolios. And so they kind of expect to have some level of rating there. But for the most part, it's not an issue for the smaller issuances. And John, you make a great point. This really is, the opportunity for folks to re-educate themselves and to plan for potential transactions. to take advantage of a bank M&A resurgence, hopefully this year. Particularly when folks get unsolicited bids from buyers. We expect, lunches to quickly transition to lunches and, hey, here's an offer. There's usually a scramble and the banks kind of get into reaction mode, right? So from a fiduciary duties perspective, I can't stress enough the importance of the process that you follow in evaluating any type of strategic offer. So, there's a few things that folks can do to prepare. Number one, your board should have a go plan in place ahead of time. For example, is there a lead independent director that can help manage the process? Many of our clients also form strategic committees or capital committees so that they can act more nimbly in evaluating offers and providing recommendations to the board of directors. Also, it's important to have pre-transaction planning conversations with your advisors. This includes legal counsel and financial advisors that have bank M&A experience, and also your tax advisors. Also, you should invite your legal counsel to provide a fiduciary duties presentation to your board with a focus on strategic matters. Sometimes it's been years since somebody's come in and has done a presentation like that. And oftentimes there are new directors that have never sat through fiduciary duties presentations. So it's really important that before folks kind of wade into the M&A kind of market, that they kind of level set those expectations ahead of time. Also, discussing with your advisors the optimal tax structure for a particular transaction. Is it a whole bank transaction more optimal than a holding company merger? Sometimes, depending if you're an S corp or a C corp, whether there's a credit union buyer at play. There are some of those considerations that come into play, and knowing what is most advantageous from a tax standpoint for the company and your shareholders ahead of time is important as you evaluate offers. And then also evaluate your material contracts, especially your core data processing agreements for termination fees, conversion fees, reviewing your employment and benefit plans for things that vest or have payouts on a change of control. All of those types of things affect pricing, and it's good to know ahead of time what type of transaction cost there might be before you get specific offers from folks. And by the way, some of these points are just as important for buyers as well. And if you have any questions, please reach out to John or to me, and we'll be happy to give you guys more information. And John, I'll kick it back to you to talk a little bit about pricing as well.
Yeah, no, thanks, Abdul. And, and a couple elements you touched on where in terms of preparing for this resurgence, if you need to see how quickly this is going to come back, going back to Brandon's slide where he showed how the country is opening back up, and you can track M&A discussions, the map would look identical. Where, I've got a colleague who covers Florida, for example, and had a period back in February where he had 5 buy-side letters of intent that he submitted with clients in a 2-week period. And, in the Midwest here, we were in the midst of, the Arctic freeze, and there were just no, limited discussions taking place. As the literal thaw, but as well as opening back up is transpiring before our eyes here, you're seeing those discussions fire back up. And really, it's kind of working its way, up north here. And, 2 of the states on Brandon's map there, Illinois, Minnesota, on the lower end of the spectrum of opening up still. As that continues to evolve, and you have, as Abdul just, referenced, have the opportunity to, hey, let's, we haven't talked in a year, let's grab lunch together. These types of discussions are going to build momentum quickly here over the springtime and heading into the summer. So it really is something, regardless of where you fall on the spectrum there, just making sure that you're aware of what's likely to transpire in your marketplace and how you can be prepared to take advantage of that. So on the next slide here, a couple elements to touch on. Pricing. Where are we in that regard? And this is a question we get a lot from clients as they're looking up, and there haven't been a lot of deal announcements since the pandemic set in. And so it's a little bit difficult to look at that and benchmark against, okay, here are 5 other transactions that look a lot like the target we're looking at. And so that gives us a pretty good idea of where pricing should come out. Pricing is coming back. It's not necessarily to where we were pre-COVID, but it's improving. and quickly, where you've seen, of course, the rally we've had in bank stocks here in the new year has been staggering. And in particular, larger banks, where there's been a bifurcation where the micro cap banks, billion, $2 billion asset banks haven't necessarily seen the same rebound in their stock price as the 10, 12, 15 plus $billion banks have, a number of which are now trading above 2 times tangible book value again. And so for the top 200 banks, which would be about 3 billion in assets and above, they are back to a median price to tangible book value of 167%. Now, if you're looking to use stock in a transaction, if you're trading at 120 price to tangible book value, it's really difficult to make the math work paying 170 price to tangible book for a target. If you're trading at 167 a tangible book, all of a sudden that math can make a lot more sense. And so with this resurgence, this uptick in bank stock prices, you're also seeing the ability to pay for these public institutions increase along with that. And that's going to trickle down to a lot of transactions. And interestingly, of course, the dynamic as well, where if that holds and some of these larger banks continue to trade at premiums versus some of the microcap banks, that can also create acquisition, merger discussion opportunities as well. Now, there are some challenges still, though, and I mentioned earnings noise here as one of them. A lot of banks are coming off of record years in 2020, which is hard to believe, but of course, that's been driven in part by PPP loan fee income, as well as a mortgage engine that just keeps on chugging here. And at some point, that mortgage gravy train is going to run out of steam. And we've got round 2 of PPP running right now. There's not going to be a round 3. That's non-recurring. And so one of the challenges in these discussions is to come to agreement in terms of what is the target bank's core earnings run rate going forward. Because that's wonderful if the target's coming off a record year in 2020, but from the buyer's perspective, you're going to be acquiring the forward earnings stream that's not going to have PPP round 3 in it. That's not necessarily going to have this mortgage environment in it anytime soon. And so how do you kind of strip some of that out and come to agreement in terms of what is the earnings stream that I'm really going to be acquiring here in this target bank, because that's what I should be paying for. And so that's been a bit of a challenge in terms of some of these conversations where if you can't show a path to getting back to a certain earnings level, it's difficult for a buyer to look at that and say, okay, I'm willing to pay you for what you did in 2020, even though I don't necessarily believe you can repeat that. And so that's one area that you really need to dig into in terms of what's the core earnings rate going forward. And then some of the other interesting areas that we're seeing activity right now, and Abdul, I'll have you touch on this as well, as I know you're seeing a lot in the fee income space. But we had a trust deal right here in Chicago that we announced last month in terms of selling a trust company to a bank here in Illinois, Midland states. We've seen a lot of activity in this space where, again, going back to the fee, the desire to build fee income in light of the challenging net interest margin environment we're in, if you have it and you can add scale to your wealth management platform. We saw that with First Busey acquiring Glenview State Bank here in Illinois, where not only did they acquire $1 billion asset bank, but they acquired $1 billion assets under management wealth management platform as well to tack onto their existing wealth management platform. That's really attractive in this environment. And so if you can find those types of opportunities, those can be a really nice way to juice your fee income as well. And Abdul, I'll let you talk a little bit about what you're seeing in that space here too.
That's right, John. And in 2019, 2020, before the pandemic hit, we were involved with a ton of these types of transactions. And in the first quarter of this year, with things opening back up a little bit, we're working on several now, including the 2 that you referenced. And these are manageable bite-sized chunks for a lot of organizations that aren't really ready to wade back into, the whole bank M&A market. And they generally don't require the same level of regulatory approval that you would see in a whole bank transaction or even a branch transaction. So they're easier to kind of execute. The potential number of parties are larger because we are seeing non-bank parties, whether they're insurance companies, mortgage companies, be both buyers and sellers of fee income type specialty businesses. So it's not surprising that that these transactions are coming back before the broader M&A market. And that leads us to a discussion of the other non-bank buyers, John, if you wanted to touch on that.
Yeah, absolutely, Abdul. And so that's another area that's been interesting to watch unfold where, just a few weeks back, we worked on a transaction involving SoFi, Social Finance, the digital lender out of San Francisco that had a de novo application in, but decided to go ahead and acquire a $150 million asset bank in Sacramento, Golden Pacific, to, in essence, help speed up and smooth their path to a national bank charter. And a lot of people looked at that and said, well, they already had their de novo application, and why'd they do that? And in essence, it gives them the ability where they've got one less regulator. They've got to the FDIC in this case that's going to need to sign off. And so, $22 million transaction value, a fraction of what they're going to pump in, where they announced post-transaction they're going to pump in about $750 million, but it gives them a platform and it eases their access to a national bank charter. So very interesting to see that transaction get announced. And then, of course, credit union buyers remain a factor. And in Indiana, as an example, we've had 4 transactions announced since the pandemic set in, 3 of which have involved credit union buyers on the smaller end of the spectrum. And so that's an area that, it can be frustrating for banks, no doubt about it. But it's something that's not going away and that we need to continue to monitor. And Abdul, I know you see plenty of activity in that space as well.
Yes, absolutely. And just touching back on, the SoFi example, there was another acquisition in California just a couple months ago, California First National Bank, that was acquired by an investor group that turned that bank into a digital only bank. They had one branch location, another bank, they were also about in that sweet spot, about $125 million of assets, where they were just looking for a bank charter to kind of turn it into a challenger type bank. So, we're aware of a number of fintech companies, investor groups that are kind of on a prowl for, banks of that range, particularly if you are a national bank, John, as you referenced, in that all the better to kind of, use as their base of deposits as opposed to going through the more strenuous, de novo application. And then on the credit union space, yes, we are seeing more of that. And that was absolutely hot right before the pandemic as well. And there are more states like Indiana and Florida that are more open to, bank to CU type of transactions. These deal structures can be a little bit complicated depending on the states that you're located in. Usually a bank can't merge with a CU. So a lot of these times, they're P&A type transactions, and there are a number of assets and liabilities that are left behind that the bank and the holding company have to unwind. So there are a lot of kind of, considerations that go into a CU type of transaction that you wouldn't normally see in a banking transaction. And it's really important to interface that with your legal counsel and socialize that with your regulators. So, so we all know that we're on the same page, because there have been regulators that have been on record to say that, they would oppose these types of transactions. And so you would have to kind of understand where your state's kind of body stands with that respect. And then, fintech to bank partnerships, and if you could spend a couple hours just talking about that, and these are turning from the transactional type of relationships where fintech A is paying fintech B or bank B to be a bank of record or to issue debit cards for them, into actual JV type relationships where banks are seeking and they're getting equity components in these fintechs. So, it's something that we're actually, tossing around to do a webinar on specifically in bank to fintech partnerships. And if that's something you're interested in, shoot me an email and we'll make sure that you get that information. So on that note, we will kick it off to my colleague and partner, Fritzi Getz, to talk a little bit about vendor agreements.
Thanks, Abdul. I'm Fritzi Getz. I'm a partner in the Financial Institutions Group with Ferrazzano. And this month I'm celebrating my 6th anniversary with the firm and working in the financial institutions industry. My practice is focused on the corporate side of things. And over the past few years, I've been involved in an increasing number of technology contract negotiations, from core processing agreements to fintech relationships and a variety of other arrangements. That work forms the foundation of what I'm going to talk about today, namely at a high level, various issues around the negotiation, excuse me, of technology agreements. The main takeaway that's been in focus for me lately is that this truly is a dynamic, high-stakes space. Things like core processing may not always be at the top of everyone's mind, but we have been having more conversations with our clients about their technology infrastructure and relationships generally. Those conversations are sometimes driven by strategic objectives. What happens if we sell or acquire another bank? What happens if we want to pursue a fintech partnership? Sometimes regulatory developments drive those conversations. The privacy corner continues to be busy, and form agreements haven't always caught up with new concerns. And sometimes these conversations are driven by a need for innovation or growth. So, for example, we've been processing in-house and that's just no longer working. So we're seeking solutions elsewhere. And then the stakes, these tech relationships are often expensive when it comes to core processing. That can be one of the most significant relationships a community or regional bank has. And these relationships are important just strictly from an operational perspective, and they implicate a lot of risk management. So regulators have produced a lot of guidance for vendors and financial institutions about how to make the playing field fair, how to manage risk, and they've generally indicated that getting ahead of potential issues should be a priority. So when we're talking about the agreements themselves, and I'm thinking particularly here of core processing agreements, they typically carry long terms, usually 5 to 7 years. The off-the-shelf vendor forms are generally not bank friendly. They also change fairly often. And they're structured painfully. There's usually a 20 or so page set of master terms and conditions, and then 100, 200, 300 pages of addenda for specific services. Sometimes those addenda provide overriding terms. Sometimes they contain pass-through terms that cannot be easily negotiated out. And then, of course, generally, we often find a leverage disparity when it comes to negotiating these agreements. Typically, a vendor will be negotiating their form hundreds of times, whereas our banking clients, of course, are not doing that. And so these agreements overall can be daunting, which makes it all the more important to marshal information in decision-making when entering a new relationship or renewing an old relationship. Technology agreements implicate so many facets of a bank typically, operational matters, an entire suite of risks, strategic considerations, and the day-to-day needs of the organization. And of course, oversight for these facets resides with different constituencies. So, bank directors, at least in theory, should know what's going on in any significant technology contract. Management, IT staff, they have to monitor operations, but also keep an eye out for innovation and improvements. There's always pressure to control costs, and there's a lot of information coming from vendor sales teams themselves. So a lot of different priorities, and it's all the more important for our clients to leverage resources. And we're finding that our clients are turning to us increasingly. So our legal reviews, whatever the relationship, will tend to straddle both pure legal side concerns and then also more business side concerns. And then, of course, we're always focused on shoring the agreement up from a regulatory perspective. So there's also a robust industry of consultants who focus on more purely business side and operational concerns, including RSM. And while every situation is different, we are finding that generally it's a value add for a client to have a third-party perspective when they begin one of these negotiations. How we get involved varies. We have different stages of entry depending on the project. Sometimes we're brought in early when it comes to the renewal of a core processing agreement, but we're also brought in for ad hoc new services from various vendors, transition between vendors, particularly again thinking of core processing there. We review addenda for new products under existing agreements from time to time. And then we also get involved sometimes on the exit from a relationship, for example, to look at deconversion fees and such in connection with a strategic transaction. So really varies. In terms of the vendors we see, ostensibly, there are a ton of core processors if you Google, but for the most part, we see a lot of FIS, Fiserv, and Jack Henry on the core processing side. We see a lot of other vendors, of course, for more discrete services. And then we also see a lot of small shops offering tailored products on the fintech side. So really runs the gamut. Can we please advance to the next slide? Okay. So to give you a sense of the bigger contractual issues we focus on, consistently we have discussions about co-termination. Vendors are typically very reluctant to provide definitive termination dates. Some banks have gotten caught in the past with straggling services and early termination penalties when they attempt to make a clean break with their provider because particular services end at various times. So making all aspects of the agreement coterminous is a big goal. Sometimes we don't quite get there, but we will at least try to build in some type of review mechanism to help the bank avoid surprises. Exclusivity has become a large focus because, of course, exclusivity can hinder a bank's ability to innovate. So recently in a core processing negotiation, we saw restrictive language that was exclusivity in everything but name. And the vendor really tried to fight on it. We ultimately reached a compromise, but there's a slow shift away from exclusivity. Similarly, service levels and SLAs, these are trending and getting a little bit better, but sometimes SLAs are not comprehensive, they're not up to date, and are not paired with appropriate remedies. For example, some services are obviously more important than others, and if there's an outage for those important services, termination should be an option for the client, not just a credit, for example. We also want to check for holes in the SLAs. Sometimes we need to push for SLAs for new, less proven products. When it comes to data ownership, so this has been a huge issue for some of our clients recently. The concern is that data needs to be portable and accessible on a continuing basis. Therefore, the definition of data and how and when the bank can access that data can be very material. This again is a dynamic environment and there are new technologies emerging all the time. So we want to ensure that if our clients need to access data in the future, that data will not be held hostage. And if there are fees associated with access, that those fees are transparent and fair. With respect to audit rights and diligence, we focus a lot on what reports need to be provided to the bank, how often, who at the bank can access them, who outside the bank can access them. If there are costs associated with the provision of reports, again, we want to make sure those are transparent. And then from a diligence perspective, we add language that the bank has a right to know what subcontractors of the vendor are engaged in providing services. We also want to make sure that we have a lot of visibility on foreign data storage and the use of any offshore resources by the vendor. Information security, of course, we continue to see both security incidents and a lot of noise around them. For example, recently the SolarWinds hack really highlighted the importance of incident response planning for banks. Technology agreements need to provide banks with the ability to comply with their incident response plans and other internal and external policies and regulatory requirements. For example, the New York Department of Financial Services requires financial institutions to immediately notify their regulator if they've been affected by a security incident. And the FDIC has proposed rules that would obligate a bank to provide notice within 36 hours to regulators if the bank has been affected by an incident. So we need vendors to provide notice within applicable windows, and we want to ensure that those obligations are contractually explicit. And I'll just discuss sunsetting quickly as well. We've found this to be a frequent issue when it comes to things like a core processing agreement. If there are a core processing service that is going to be sunset by the vendor, often we will try to make sure that that is accompanied by a termination right by the bank. This again is something that needs to be negotiated pretty heavily typically. And then of course we focus on kind of the typical suite that you would expect for our legal review. We'll spend a lot of time on limitations of liability, warranties, liquidated damages, and those types of matters. So I'll close by just highlighting several questions I find myself asking clients, whether that's management, maybe a director, often an internal IT person, when these topics come up. One of those questions, who are your key vendors? Have you experienced any issues with your current vendors? We've had clients report outages or issues with certain products, and it's helpful for us to have perspective, particularly as we're negotiating things like SLAs. And though it's sometimes easy to vilify core processors, we also have clients that love their providers. So it's really helpful for us to understand those relationships. Additional questions, do you know if your existing agreement restricts you from engaging a new provider? Are you considering any big changes? Did you work with outside consultants or have a legal review of a specific agreement the last time it was up for negotiation? And then generally, is the bank's technology where it needs to be? Whether that's from a security perspective, customer expectations, can the staff do what it needs to do? So I think that's about all the time I have, but I'm happy to be a resource and answer any questions during the Q&A. But now I'll be turning it over to Jennifer Doherty.
Thanks, Richie. Good morning, everyone. Brian, do you mind just going to the next slide there? Thank you. So Anthony and I are going to spend a couple of minutes talking about ESG. Obviously, we're not going to cover everything here. And so as Richie said, I'd encourage anyone with follow-up questions to reach out to us and to reach out to the folks at Barrick. Brandon mentioned the focus out of Washington on climate change and how that's driving ESG, and that's true. But to be honest, I can't quite frankly tell you why ESG is the topic du jour. What I can tell you is that I think it's a good thing for the banking industry. And in particular, I think it's a very good thing for community banking. I don't know that anyone else looks at ESG this way, but I think really high level and most simply, ESG is a prism for evaluating risks and opportunities by expanding the definition of stakeholder in a way that improves returns and reduces the cost of capital. And so if you take a look at the next slide here, ESG is in community banks' DNA. Right? I mean, this is what we do. There is no bank. John talked a lot about valuation. There's no bank that isn't ultimately valued based on the strength of management and the markets that you sit in. And understanding your community is what you do best. It's customers, it's employees, it's shareholders, it's your community reputation, and its environment. Brandon also mentioned the Paycheck Protection Program, and there's nobody on this call who doesn't understand what that was involved very intimately. There's a ton of work. One of the things I think the banking industry suffered from coming out of the great financial recession was a big black eye, and this financial crisis induced by the pandemic really was an opportunity for the banking industry to change the perception, and rolling out the PPP was a critical part of that. And it really reestablished for people why community banking is so central to the US economy. So ESG, I think, is just another prism for highlighting what banks do well. If you take a look at the next slide here, it kind of explains why constituents care about ESG. Again, when you think about this as a prism for understanding business risks and opportunities, it's not surprising that institutional investors, the SEC, rating agencies, and I'm going to start at the bottom of the page here, because I talked about this being a critical piece of how community banks operate and why I think community banking is really an undervalued ESG asset. One of the largest buyers of bank debt got into the space in part because of the pressures they were getting from their own investors to focus on ESG, and the belief that community banking really does ESG very well because we're very focused on the community. Kroll was mentioned. Kroll has been a big part of corporate debt issuances for community banks, probably one of the biggest rating agencies supporting the capital markets for community bank debt issuances. Kroll is focused on this for the same reasons that Moody's and some of the other rating agencies are. ESG is ultimately about risk management. The SEC, and this is something that hopefully for public companies who are here spending some time talking to the folks at Barrick about, the SEC is focused on this from in terms of human capital. You know, the most important off balance sheet asset that we all have is our people. And so understanding that in a more intimate basis, you know, and Anthony's going to talk for a minute about how you measure that and how you start to benchmark yourself. But that really is what ESG is about. The institutional investor community also very focused on ESG. Again, public companies have been wrestling with proxy disclosures around this. ISS and Glass Lewis in particular recommending votes for or against board candidates based on disclosure of effectively addressing ESG issues. We're going to talk about gender diversity in a little bit and how that fits in. But bottom line, I think this is a real opportunity for banks to showcase something that they've always done well. And turn it over to Anthony to talk a little bit more about what that looks like and how you really get underneath the numbers.
Well, great. Jen, thank you for that background. And again, everyone, my name is Anthony DiCandido. I'm a partner here within our RSM practice. You'll notice on camera here, I'm the faceless man. Forgive me, I'm having technology problems, but I am available on phone, luckily. But let's just get into some of the nitty gritty here. So when you look at the slide here, we've titled this Trends in Banking. We recognize the fact that when we advise clients, every organization thinks of ESG in a different way. But when I consider what it means, I think of it in the context of this concept that organizations today are no longer being measured just by virtue of their financial returns alone, but instead they need to be simultaneously measured for the types of societal outcomes that they create organizationally. In the banking sector, we boil that down into three particular components. This idea that customers in general require more transparency. There's requirements for increased responsible investment. And then lastly, that there's better culture and ethics within an organization. And Jen mentioned this earlier, but when we boil down into the first two, the financial crisis was the event that highlighted the importance of financial transparency and responsible investing. So between 2003 and 2006, the percentage of mortgage originations that were subprime, they increased by a lot, from about 8% to 20%. And that was mainly driven by strategic decisions by the banks to steer borrowers into more risky products, as well as to offer loans to those who were previously unable to qualify. And these practices increased the risk of default. They led to, an estimated something like $4 million worth of foreclosures between 2007 and 2012. Now, on the culture and ethics side, the corporate culture and brand leadership that'll emerge as a result of these ESG behaviors will secure the company's competitive edge going forward. And I've said this many times across all the industries that we serve here at RSM. It's, particularly during COVID, the seeds that we're planting with our professional staff today have the ability to bear many fruit down the road if companies are exuding the right behaviors. And we also recognize the fact that organizations that have better diversity of views are also expected to achieve above normal financial results. So what does this all mean? If we move into the next slide here, what we've done at RSM is we've designed what we refer to as a rapid assessment impact approach. And what that is essentially a 2 to 3 week sprint where we go in, we kick the tires of an organization, we speak to a lot of the key stakeholders, whether it's board level, CEO level, technology, underwriters, you name it. And we begin to frame for them the various different reporting frameworks that they may align themselves to in order to produce an end deliverable, knowing that many of the investors today are asking for it or even requiring it. And then simultaneously, we're evaluating what's going on within that market. How might an organization benchmark their KPIs to another organization? If you're just beginning, you may instead be looking at, well, how do we change behavior within the organization before getting outside to doing some of that competitive analysis? But one way or the other, when we start, more times than not in the banking sector, we recognize the fact that because so many organizations in this space are listed entities, the financial reporting framework that tends to align best to companies of this type is what's referred to as Sustainability Accounting Standards Board, or SASB. And what's neat about the SASB framework is that it's a code which is designed to be industry specific. So we at RSM, we cover many priority industries. We could get into all that they are, but in short, it's things like healthcare and consumer and industrial products and financials. And every one of these sectors has its own code, if you will, representing the topics and ESG behaviors that are most relevant to that particular vertical. And what's neat about this framework is it helps those corporations disclose material and also decision useful information to its investors. So if you read along with me on the slide, the way in which we've organized the slide is so that the red frames are the topics that are of the highest environmental importance for banks. The blue frames are those that are of the highest importance for social topics. And then lastly, the green frames for governance topics. So I'm just going to read through a few of them with you just to strike a chord, because you and your boards may have already considered some of these things. So obviously environment, we talk about social capital, different lending practices. We talk about community investment and the impact that we may have economically. PPP loans is probably the best of those such recent examples. We think about things like data security and protecting our customers' confidential information, going all the way down to gender pay equality issues or business ethic issues, employee trainings, and on and on and on. But what we think is important to note is that when we begin these projects with our clients, although there is a framework, more times than not, organizations select those KPIs which align to their own missions and values. And so I think it's important to note that for those that might just be beginning to think about this or just starting their own ESG reporting, we do have these frameworks, but there is the ability for us to tailor what that looks like with you. So when we move on to the next slide, we also recognize that as we get deeper into any particular vertical, in this case, we're talking financials, we recognize the fact that there's also other principles that apply to sector-specific frameworks, which have some crossover principles from the major reporting frameworks groups like SASB or Principles of Responsible Investing or GRI or Task Force for Related Climate Change. And so when you read through the slide with me, we're talking about things like business strategy and impact and target setting. We're talking about the impact that we might have with our clients and our customers, governance and culture, transparency and accounting. These are all one way or another, whether it's a SASB framework or a sector-specific framework, relevant to a banking organization in terms of setting forth their ESG reporting strategy. Okay, just a few other pieces of information about this one in particular. UNEP has over 100 supporting institutions. This group is comprised of some of the best-in-class banks within their relative market cap spaces. So if I were to share that list with you, you'd recognize a lot of the major players, but you would also notice the fact that there's a lot of the regional type banks that are in there as well. So moving on to the next slide, when we set forth on these rapid assessment studies that I described earlier, we inevitably get to a place also where a board will ask us, well, what are others doing within this practice and within this industry? And we just worked with one recently in the Southeast. This is a regional community bank. And their mandate was very firm when we first met with them. They said, despite our size, they're roughly $1 billion bank of loans, they wanted to become the best-in-class regional community bank on a national level. So although it would have been more natural for them to benchmark themselves across similar type of revenue or market cap space banks, they instead wanted to look upstream. And so here's some of the slides that we had prepared for this particular study, just highlighting what other best-in-class banks have done in and around ESG and corporate social responsibility. So if you follow along with me, you'll notice, some of the brand names, whether it's Capital One or First Republic, many of these groups have publicly available corporate social responsibility reports. But what you'll notice is there's a bit of a divergence between what frameworks these groups may use relative to another. And it could be because of a variety of reasons. Do they have an international footprint? Do they not? What are the type of borrowers that are most common of that particular bank. But what we do for them is we lay out what is happening in that market so that they can benchmark themselves against. So when we move on to the next slide, it's much of the same, but we recognize that some of these more local and regional banks, they may not have gotten very far. So on the previous slide, there was a group referenced Eagle Tree Bank. They were a little bit closer in size as the subject company that we were evaluating. And in that case, they had no such reports available. And so, back to the point about being best in class, they viewed themselves as having a little bit more of a footprint that way than their peers. Okay. So we move on to the very last slide. I think it's important to put this in here because so much of what we're talking about is still theoretical. And, what we find when we begin these projects is, the practicality of the analysis is something that many boards still struggle ascertaining. And so I thought this here would be one of the most basic ESG types examples, which will highlight all the different iterations of how an organization might evaluate a particular ESG topic. In this case, we're talking about diversity and inclusion. So one of the undertones of ESG reporting and data normalization is this whole concept of how, the analysis in the eyes of the beholder. So if I were to tell you right now that an organization had, 20 women out of 100, that would mean something based upon how you understood that company or that company's role in society. If we drill down much deeper and we instead compared, what the gender pay difference might be at a department by department level, along with rank, meaning VP level, president level, board level, you name it, that may tell a different story entirely, and on and on and on and on. So one of the things we oftentimes work with companies to create is this ESG journey. So if you're just getting started, beginning to report some of these things, I think would be important. But to me, the real, the best ability here to drive corporate strategy and drive those, above normal financial results is when we really dig deeper in underneath the hood to understand what are the narratives amidst all these various topics. So if we were to do such an analysis for any of the bank board members or executives on this call, just understand that this D&I exercise that I'm sharing with you here can be applied across all of those topics that we had on the previous few slides with all those frames, okay? And the last thing I'll say before just passing this back to Jen is, depending upon the size of the organization that you are, it may dictate how far you go with this. So this is very much in our eyes a journey. It's not something that you're going to create a program best in class overnight. It takes some time and deliberation over. And so we've been grateful for the opportunities we've had as a firm to coach our clients through this process. Okay, so that's all from me. Thanks for your attention. I'm now going to pass it back to Jen to close us out with some diversity topics.
Thanks, Anthony. And I think you make a really good point about banks choosing which are the areas to focus on. The whole point behind ESG really is to try to quantify what we've always talked about as intangibles, but the intangibles that really do drive results. And so while it's important to show well because you have external constituents that care about it, it's more important to understand what really drives your business returns and to have an ability to start quantifying that so you can see where there are gaps and opportunities. So I got a couple slides here that just focus on gender diversity and why this is stakeholder engagement and how this fits into ESG. The data here is not surprising, right? Women form the majority of bank customers, employees, owners, and community. Again, I should probably reorder my slides. I'm starting at the bottom and working my way up on everything today. But women make up more than 50% of the workforce, are now receiving nearly 60% of all advanced degrees, and pre-pandemic held more jobs in the US than men. So our talent pool is more than half women. So if you want the best and the brightest, you need to make sure you're casting a wide net here. John mentioned a really good point. Wealth management fee revenue is a really important thing for banks right now. Women are the primary breadwinner in over 40% of US households, comprise more than 50% of stock owners. And this next bullet is really interesting. You should start to think about the demographic trends over the next 10 years as baby boomers start to age. Women control roughly 11 trillion in assets now, but by 2030 are expected to grow significantly. The other thing John mentioned, I'm going to keep coming back to the things that John said earlier today. Lending opportunities are really challenging right now. And Brenda mentioned at the outset some of the industries that were more adversely affected during the pandemic: hospitality, leisure, service. A lot of those businesses were disproportionately owned by women. So focusing on helping the economy come back out of the recession, rebuilding those businesses where the lending opportunities are, marry that with the statistics about women starting more small businesses over the last 5 years than any other group, men and women combined. You start to see that by focusing on gender diversity in your communities and among your talent base, it really drives returns. We'll take a look at the last slide here before turning it over. This is direct data. There are a lot of studies done like this. You can't prove causality, but over and over again, both within the banking system and in industry more broadly, you see a very high correlation between having a critical mass of women in corporate leadership, so the C-suite and the boardroom, and performance metrics. So this study here looked at the increase from 0 to 30% of the number of women in corporate leadership, found a correlation of 50% improvement in profitability. And I'm going to keep talking about this critical mass concept. When the representation of women in top management went from less than 10 to more than 15%, you saw a correlation of a 5% improvement in return on equity. I'm going to jump to the last one here. This is really important. Abdul and John spent a lot of time talking about fintech and how that is reshaping the way the banking space operates. When employees believe their organization is committed to inclusion, correlated with an 83% improvement in the ability to innovate. So the critical mass piece here, and I'll try not to be political, but I think, we focus a lot on pressures coming out of Washington, pressures coming out of the regulatory agencies. What the data really shows is that you have to believe in this. Just hiring one woman, one minority, and having them viewed as sort of a token, they're there not because of their skills and expertise, but because they fit a certain category, isn't going to get you where you want to be. But again, when you start to peel back the layers here of ESG and you focus on what is it at the stakeholder engagement level that really makes your bank best, and where are your blind spots, where can you improve, you start to see that there's a tremendous opportunity here. With that, I will turn it over to John and John for what I understand is the infamous Behringer-Geiringer report.
Thanks, Jana. Hopefully not too infamous, but appreciate that. So John Behringer, excited to be presenting again with my colleague, peer, and good friend, Mr. John Geiringer, albeit virtually. Looking forward to when we can do this in person again, my friend. But today we're going to take a little bit different tact. We're going to run through really three kind of main areas: legislative, regulatory, and supervisory. And then the fourth category, in honor of Jeopardy here, and I think Alex Trebek will call potpourri, which will be kind of just a smorgasbord of, if we can still do that in the era of COVID, a buffet, if you will, of various banking compliance and safety and soundness matters. So with that, Mr. Geiringer, I will let you take it away with some legislative updates.
Thank you, Mr. Behringer, and look forward to giving you a big hug someday. So
I can't wait.
So we've got to cover the entire regulatory landscape in 10 minutes. I think we can do it. Let's start on the legislative front. BSA, just like me, is 50 years old, both born in 1970. Both of us clearly need a tune-up, and Congress actually did it this year with respect to BSA. Not me. I've got my tune-up hopefully planned soon. So with respect to BSA AML, Congress passed an Anti-Money Laundering Act of 2020 that we're going to be hearing a lot more over the next coming months. There's a lot of rulemaking to do. The good news is it takes some burdens off of banks, for example, with respect to beneficial ownership. That's going to be moved over to FinCEN eventually. It's going to put some burdens on banks to do some more risk reviews, both of customers and I think of their general environment. And when I think about that, you have to think about the events of January 6th and last summer in the context of this new expression we're all hearing about, domestic violent extremism. Because for the last 20 years, we've all been so focused on international terrorism as banks from the BSA AML perspective. And to some extent, it was pretty easy because there are certain designated foreign terrorist groups. There are lists of individuals we can't do business with on the OFAC list. With domestic violent extremism, it's a little bit harder because there is no such list. And what winds up happening is that every institution, no matter what its size, has to be its own financial intelligence unit, an FIU, if you've heard that expression before. Some of the banks on this call have whole floors of BSA folks who can tackle these issues. For some of our community banks, it's just the one BSA officer. And so no matter what your size, you need to really understand your complexity and your risk among your customer base and even among your employee base for the whole spectrum of domestic violent extremism issues. I strongly encourage all of you to be thinking more along these lines, looking at open source reporting, because there isn't much government reporting on this, and you're gonna have to figure out, you can go to websites such as Southern Poverty Law Center and others that have heat maps, and the ADL has you've got heat maps and where you can determine where you have domestic violent extremism groups and individuals. And really, it'll help you do that sort of risk assessment. We'll have plenty more to say on that in the coming few months. The other legislative factor that we're going to see over the next few months, I suspect, is on the marijuana issue. Everyone's favorite topic. I would suspect in the next 2 years under this Congress, we're going to get some movement either on some combination of the SAFE Act, which makes it legal for banks, the SAFE Act, which makes it legal within the states, and then the MORE Act, which makes it legal across the board. No matter which legislative vehicle ultimately races to the finish line, I think all banks, it's incumbent upon you to make the decision on to what extent you're going to bank marijuana-related customers and businesses, and if so, how much. And even if you don't make a decision, that's making a decision. So even when it becomes legal, I suspect it's still going to be a very high risk enterprise that banks and their regulators are going to have heightened expectations surrounding those things. And so I think it's incumbent upon all banks to be thinking about how that's going to play out over the next few months. On the Illinois legislative side, for those of you state charter banks, you will now have a state community reinvestment act regime in which you need to operate. And just when you think you national banks operating in Illinois have dodged a bullet on that because it doesn't technically apply to you, I think you're going to have to still be cognizant of what the DFPR, the state regulator, ultimately comes up with rulemaking, because you may be judged against your state chartered counterparts when it comes down to things like deposit making by the state treasurer or Illinois agencies. And that bill that was just passed a couple of days ago also has some diversity in procurement issues for the state of Illinois. So even if you're a national bank, but if you do some state of Illinois procurement, you're gonna have to be sensitive to those diversity requirements. On the regulatory side, a few of the regulators are going to remain the same, right? The FDIC and the Fed for the next year or two, those terms are still outstanding. I think we're going to see the biggest change, obviously, at the CFPB, whose posture I think is going to shift dramatically to more of a consumer protection path, more drill downs on fair lending. So to the extent people have dropped their guard maybe a little bit on fair lending issues and taking a deep dive into their analytics, especially when they had to do things in a hurry, like on PPP, I think it's time to bring that guard back up and really have a good sense of where you are with respect to how you deal with your customers by putting yourselves in their shoes when you look at your website, when you look at your agreements and your products and services, to make sure that there's no disconnect between what you think you're offering and what you're actually offering. I think we're going to see movement among the regulators this year in Community Reinvestment Act on the federal side, and hopefully all the agencies are going to somewhat align to how they're going to think about CRA in this new era. And then executive compensation was been put on ice back in 2016. It is still mandated by Dodd-Frank. So I would expect to see the regulators come together on issues around executive comp. And so again, I would be taking a look at your incentive-based compensation program at your own institutions to make sure that you're properly aligning risk and reward, and you have the proper holdbacks and clawbacks and all those sorts of things. Forget the regulators, just from your own perspective, to make sure you're not falling into the same trap as we saw some institutions get themselves in the last crisis, when they were paying for, in effect, quality and not quantity. John, take it away.
Thanks. Another topic that's really kind of starting to rise back up as we kind of start to get back to non-COVID issues is Libor. And I'm sure many of you are aware we've got a transition date away from Libor, December 31, 2021. That's firm, and I think there's at times some confusion around that. This isn't a regulatory action. Libor is an independent body. It's going away. And so, if you haven't yet, and it seems like a lot of our community banks, at least, and some of the local financial institutions haven't necessarily looked at it, Libor is very pervasive in everything we do. So while you may not be tying any of your loan portfolio to Libor, you likely have other contracts within the organization that are tied to Libor, whether it's with vendors, whether it's with some of your borrowing agreements. So really would encourage you, if you haven't already, to make sure you've done an inventory of your contracts and look at those that are referenced to or tied to Libor. And then with that, once you have that kind of inventory, make sure you understand the exposure and are there required actions. So you need to enter into is there fallback language provided? If not, do you need to follow up and understand what that fallback language is? And by fallback, meaning what's our fallback provision to a different reference rate? And then I think the other thing that's really important, and I think some organizations are a little bit behind on as well, is understanding what your alternatives are to Libor. It seems like SOFR is going to be the winner. It's an overnight rate that's going to be published by the Fed. The challenge with that is there's not really a risk component to it. So we've seen some folks start to look at things like a Maribor as an alternative. So I think, again, if you haven't started to think about Libor and the impact on your organization, or you've started to think about it but kind of backburnered it, now is the time to move that back to the front here and make sure you're thinking about impact on the organization as a whole. The other thing, and I'll just touch on this quickly, is, as I think we've alluded to throughout with the new administration, we're seeing changes in the regulatory footing and posture, I guess I would say. And one of the things we've seen come up the last couple of days, again, is climate change and the impact that may have from a financial reporting as well as from a regulatory perspective in the financial system, and in particular, the banking space. Right now, I'm not going to postulate or try to guess where it's going. I think it's worth just monitoring and recognizing a lot of these issues kind of formulate and come under what Anthony and Jen were talking about around ESG. And I think how that impacts our industry is going to be critical. So we want to make sure we're keeping an eye on that and thinking about that. Recognizing we're coming up on 2 minutes, Mr. Geiringer, I'm going to hand it back to you since I don't see any questions in the queue to maybe bring us on home.
Sure. As the sands of the hourglass go down, the things we're seeing on the supervisory front, if you haven't yet experienced an offsite exam, you're going to have to build some muscles around having better communications with your exam team. We've also seen a bit of a digital divide between banks that have not yet digitized a lot of their records. And so I would encourage you to be thinking about how to do that quickly. If your exam is coming up, it makes the exam process go more smoothly. And also encourage you to treat exams under the offsite era like you would on the onsite era. So instead of walking into their offices and knocking on their door and seeing how the exam is going, check in on phone, on Zoom. I think you've got to keep that same level of engagement going to make exams run more smoothly. In the potpourri department, the things that we're seeing are, plenty of banks over the next few months, and certainly we've been seeing over the last few months, are engaging in dividends or repurchases or redemptions. Everyone's favorite document from the Fed, 09-4, which governs that, has really been a bit of a mess, frankly, and we've been having some discussions with the Federal Reserve on how to clean that up in terms of making sure the expectations are clear around when you need approval, when you need consultation, when you need no objection, and how much time you need to give the Fed to give you that feedback. And so stay tuned. We'll be talking about more of that in the coming weeks and months. And then finally, one thing I should mention that we have been seeing a lot lately, and I would put it under the rubric of corporate hygiene. And by that, I mean not the Purell bottles in your banks, but I mean your governance documents. And that can be bylaws. That can be your Regulation O related interest forms. That can be your change of control analysis of who owns you as a company. We've been seeing lately that a lot of institutions have let some of those things get stale in terms of who the related interests of the directors are. So you know with whom you can engage in lending under certain circumstances. So you know how many folks are allowed to be on your board of directors. So you know in the sense of who controls your organization. That frequently changes, you know, when you have estate planning at the holding company level. That's something we've been working with a lot of our clients on. So I would encourage you to take a fresh look at those documents, make sure they're up to date, and we obviously be happy to help you. And with that, I think we are out of time. So stay safe, everyone.
Great. Well, thank you, John and John. Terrific performance by all of our contributors today. So thanks to each of you, and thanks to the attendees for taking 90 minutes out of your day and tuning in for this. We really appreciate it and hope that we can continue the conversation and keep your eyes open for future invites, for future updates. You will get a follow-up email from us with links to the slides. I believe we're recording the presentation as well, so you can rewatch different portions of it, as well as having information on how to get CPE and CLE credit. So thank you, everyone, and have a great rest of the day.